Warren Buffett was not born into glamour, privilege, or the mythology of Wall Street. He was born on August 30th, 1930, in Omaha, Nebraska, at one of the most fragile economic moments in modern history. America was in the depths of the Great Depression. Banks were collapsing by the thousands. Businesses were failing. Families were losing everything. Fear wasn't abstract. It was daily reality. Yet inside that environment of scarcity, a quiet obsession was forming. While other boys played baseball or dreamed of becoming athletes, Warren Buffett was studying numbers. He wasn't fascinated by money as a symbol of luxury. He was fascinated by how it multiplied, how it moved, how it grew when left alone. His father, Howard Buffett, was a stockbroker who later became a U.S. congressman. Dinner conversations often revolved around markets, businesses, and economic cycles. From an early age, Warren absorbed the language of finance. He spent hours in his father's brokerage office writing stock prices on the chalkboard. By 11 years old, he made his first investment. He bought shares of City Service Preferred at 38. It wasn't just his money. His sister had trusted him with her savings, too. The stock quickly dropped to 27. The loss felt real. He felt the immense pressure of losing someone else's capital. He held on, terrified but stubborn. When it recovered to $40, he sold for a small profit of about $5 per share. He felt relieved. Then he watched in horror as the stock surged past $200. That moment reshaped him permanently. The lesson was clear: impatience destroys wealth. The market transfers money from the impatient to the patient. He realized that selling too soon to capture a tiny gain is just as dangerous as holding a loser too long. By 13, Buffett was already operating like a small-scale capitalist. He delivered newspapers before dawn, throwing over 500 papers each morning. He didn't just throw them, he optimized his route to maximize speed. He sold Coca-Cola door-to-door and filed his first tax return, deducting his bicycle and his watch as necessary business expenses. In high school, he and a friend bought a used pinball machine for $25. They installed it in a local barber shop. Buffett's logic was simple. Men waiting for haircuts had loose change and time to kill. The machine generated passive income immediately. Instead of spending the profits, they reinvested them into more machines. Within months, they had a small empire of pinball machines across Washington, D.C. barbershops. He understood something early that many never grasp. Income from labor is limited by your time. Income from assets scales infinitely. After graduating from the University of Nebraska in just 3 years, Buffett applied to Harvard Business School. He was confident. He had read every business book in the library. He was rejected after a 10-minute interview. The interviewer simply told him he wasn't a fit. Instead, he enrolled at Columbia Business School to study under Benjamin Graham, the author of The Intelligent Investor. That rejection turned into a strategic advantage. It was the best thing that ever happened to him. Graham taught him the intellectual foundation of value investing. Stocks were not lottery tickets or squiggly lines on a chart. They were ownership stakes in real businesses. Every company had an intrinsic value independent of market emotion, and the key principle was the margin of safety, buying significantly below intrinsic value to protect against error. If a dollar bill is selling for 50 cents, you buy it. You don't worry about whether it drops to 40 cents next week. This framework gave Buffett something more powerful than intelligence. It gave him emotional discipline. In 1956, at 25 years old, he returned to Omaha and launched Buffett Partnership Limited with roughly $105,000 from friends and family. Only $100,000 was his own money. His structure was radical. No fixed salary. He would only take a percentage of profits above a 6% return. If investors didn't win, he didn't win. That alignment built trust, and performance followed. Throughout the late 1950s and early 1960s, Buffett compounded capital at extraordinary rates, largely by buying cigar butts, companies that were dying but had one last puff of value left in them. Eventually, he began buying shares in a struggling textile firm, Berkshire Hathaway. It was cheap. It was trading way below its book value. But structurally, it was a terrible business. The textile industry was moving overseas. He later admitted it was one of his worst purchases, driven by anger at the previous CEO who tried to shortchange him on a tender offer. He bought control of the company out of spite. Yet here is where strategic thinking separated him from ordinary investors. Instead of drowning with a failing textile business, Buffett repurposed Berkshire. He stopped putting money back into the mills. He took the cash the mills produced and used it to buy other, better businesses. The real turning point came when he acquired an insurance company, National Indemnity, in 1967. Insurance introduced him to the concept of float. Insurance companies collect premiums typically up front and pay claims later. That pool of money, float, can be invested in the meantime. It functions like a massive interest-free loan that never has to be paid back as long as the insurance operations are sound. Float became the thermonuclear engine of Berkshire Hathaway. It allowed Buffett to invest billions without relying heavily on debt. It amplified returns while preserving structural stability. As his philosophy evolved, influenced heavily by his partner Charlie Munger, Buffett shifted. He moved from buying fair companies at wonderful prices, the cigar butts, to buying wonderful companies at fair prices. He focused on what he called economic moats. Just as a castle is protected by a moat to keep enemies away, a great business must have a durable advantage. Strong brands, network effects, pricing power, customer loyalty, switching costs. He wasn't interested in businesses that had to fight every year to survive. He wanted businesses that dominated. He famously said, "I look for businesses with a big moat with piranhas and crocodiles in it." In 1987, global markets crashed. Panic spread. Investors fled. Black Monday saw the market drop over 22% in a single day. Buffett didn't panic. He bought Coca-Cola. He saw a brand embedded in global culture. He understood the mathematics of scale. A simple thought experiment drove the investment. If Coca-Cola increased the price of a can by just 1 penny, nobody would stop drinking it. But that 1 penny, multiplied by billions of servings daily, produced enormous incremental pure profit. He invested over $1 billion, a huge percentage of his portfolio at the time. Critics said he overpaid. History proved otherwise. The dividends alone from that investment now pay massively every year. Then came the dot-com bubble of the late 1990s. Technology stocks soared. Companies without earnings or even revenue were valued at billions. Day traders were becoming millionaires. Buffett refused to participate. The media mocked him. They called him a dinosaur. They said the game had passed him by. He relied on his circle of competence. If he did not fully understand the long-term economics of a business, he would not invest. He accepted the risk of missing upside in exchange for avoiding permanent loss. He didn't know which internet companies would survive, so he bought none of them. When the bubble burst in 2000, trillions vanished. Pets.com went to zero. Berkshire remained stable. Discipline preserved capital when genius failed. Years later, in 2016, Buffett made another major move, Apple. Many saw it as contradictory to his no-tech stance. But Buffett did not see Apple as a technology hardware stock. He saw it as a consumer goods company with extraordinary loyalty. He observed that people would give up their car before they gave up their iPhone. The ecosystem was sticky. Once you were in, you didn't leave. The iPhone wasn't just a phone. It was infrastructure for modern life. It was real estate in people's pockets. Apple became Berkshire's largest holding, earning billions in paper profits. Despite extraordinary wealth, over $100 billion, Buffett's lifestyle remained scientifically modest. He still lives in the same Omaha house he bought in 1958 for $31,500. His salary has been $100,000 per year for decades, less than many mid-level managers. He drives himself to work. On his way, he stops at McDonald's for breakfast. If the market is down, he buys the cheaper sandwich to save a few cents. This isn't a performance, it's a philosophy. His wealth rises and falls with shareholders. He eats his own cooking. He spends 80% of his day reading annual reports, financial statements, newspapers, biographies. He believes knowledge compounds exactly like capital. The more you read, the better your judgment becomes. He famously pointed to a stack of papers and said, "Read 500 pages like this every week." That's how knowledge works. It builds up like compound interest. During the financial crisis of 2008, when markets collapsed and fear dominated headlines, Buffett deployed capital aggressively. He became the lender of last resort. He invested in Goldman Sachs and General Electric under highly favorable terms because they were desperate for his credibility and his cash. His principle remained consistent: be fearful when others are greedy, and greedy when others are fearful. Late in life, Buffett shifted his focus toward the ultimate distribution of his capital. In 2006, he pledged to donate more than 99% of his fortune. Rather than create a new foundation with huge overhead, he entrusted much of his wealth to the Bill and Melinda Gates Foundation. He viewed money not as a symbol of status, but as claim checks on society's resources. He believed that leaving massive dynastic wealth to children simply because of the womb they emerged from was a disservice to both the children and society. Together with Bill Gates, he launched the Giving Pledge, encouraging billionaires to commit at least half their wealth to philanthropy. Buffett's legacy is not simply financial, it is philosophical. A $10,000 investment in Berkshire Hathaway in 1965 would be worth hundreds of millions today. That is a statistical fact, but the real lesson is not about the number, it is about the method. Patience over impulse, discipline over emotion, long-term thinking over short-term excitement. He proved that integrity can be a structural advantage, that restraint can outperform aggression, that clarity can outperform noise. In a world obsessed with speed, high-frequency trading, and quarterly earnings, Warren Buffett slowed down. He played a different game entirely. And by doing so, the boy from Omaha who loved numbers built not just a fortune, but one of the most extraordinary legacies in the history of capitalism. If you found value in this breakdown and want more deep-dive documentaries on business legends and investment strategy, make sure to like this video and subscribe to the channel. Because just like capital, knowledge compounds, and I'll see you in the next one.